I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
There's a point in 2004, where I started using private equity, right? So it was just me and one other person, or me and a loan from a private equity person. Somebody I knew who was a client or a student or somebody who came to my Phoebe meeting, right? Somebody, and they would lend me money. And then, but I still wasn't overly leveraged. So in 2009 and 10, when it all went downhill, that was my money. That was my money I was losing, right? So I can get this. So I sold everything, and then I went back in 2015. I started reinvesting again, and then I really was I bought flips with none of my own money.
Yeah.
So I got a private equity for the down payment. I got a hard money loan for the purchase and the construction, and I was now the backstop. And so I lost $350,000 on one of my deals. So guess who paid out $350,000 from her portfolio to make her investor whole? And if the investor is listening to this, he will know who he is, but I never told him I was making him whole. I simply said, here's your money and your interest. I'm sorry there was no growth on the equity part of your investment, but here's everything to make you whole. Right? And so now all of a sudden there's a different level of anxiety. That is a different game. So now you've got them next to each other. Talk to that, because I think that's super critical.
Yeah, a lot of people don't think about that when you get in. There's benefits and drawbacks to both methods, right? Partnering up, doing syndications, whatever you want to call it, real estate private equity allows you to scale. It allows you to make huge returns if you're the general partner, right? Because you can get into that promised land of the promote or the carry, as they say, right? And then you're making money for your efforts instead of just a return on your invested capital, but you're also investing some of your money with your LPs. Gets you into larger deals. You get to charge fees. You get to make a whole business out of it. Totally understand all that. And so it's enticing when you look at that on paper and you see what can be done. If everything goes well, it looks like the fast track to riches, 8-9 figure wealth, and it can be. But we're seeing now how difficult that structure can be in a downturn, right? So really through a lot of people's no fault of their own, the financing environment has completely changed in the last 4 years. Fundamentally, a lot of deals are fine. I think it depends on where you invest, and we can talk about that too. Vacancy rates are really high in other markets, but not here. The real market's a little bit soft, but generally the fundamentals are fine. It's really financial distress that's hit these deals. And then when you have to try and right the ship and not lose everything and not lose your investor money that you've taken, your options are much more complicated. You have to do capital calls. You have to source member loans. You have to try and get rescue equity, rescue debt from other places. And then people are always thinking about it in terms of, when do I get my money back? I gave this to you. When do I get my money back? Where's my return? And so the mindset and the attitude is completely different. You are their servant as their GP, right? You are their steward, I should say, is a better word for it.
Let's dig into a little bit, where is multifamily right now? Because I think people really need to understand that, because I'm actively purchasing and moving into creating more syndication deals where I'm a GP or the managing partner of a investment club, right? So I'm moving into this, not stepping away from it.
I think you're well positioned to do that. Now would be the time. As an asset class, cyclically, it's hard to think that we're not really bottomed out right now, or barring some other exogenous macro event, we're going to be at the bottom of this cycle here in the next 6 to 12 months.
6 to 12 months, I agree.
And it might even be behind us. It just depends on what happens in the world and with the 10-year and interest rates and all this, and some of the fundamentals in some of these markets. So when you look at the long-term charts, it's really clear. The trends are obvious. We're in 4 years into a downturn. Values are down 25%-ish, depending on what you're investing in and where you're investing and what your rent roll looks like. But banks are lending. Sentiment's still pretty bad with investors. There's not a lot of buyers out there. It's a buyer's market if you are a buyer. And there's a lot of sellers. There's a lot of people in the situation that we were talking about earlier, where they can't refinance. They don't have the cash to do a cash in refinance, or they can't do a capital call, or for whatever reason, they're going to sell strategically and, walk away. And those are the times when the getting is good if you're a buyer. So whether you're putting together syndicated deals like you are, or whether you're an individual investor like me, for the most part. It is a great time to buy. And of course, it's always that opposite sentiment strategy that you want to follow. Everybody loves tech and AI, and the stock market's raging right now. And yes, if more of my balance sheet had been in the, even just the S&P, I would have made so much more money over the last 3 years rather than losing millions of dollars. But now would be the time to rotate.
I'm not taking the hit on this one like I did before, but my empathy, my pain is right with you when you say that. I'm like, oh man,
it's been bad. But now's the time, right? I mean, it's really clear. Cap rates are up in the 6s in a lot of markets, or high 5s, even 7s in some areas here, even in Southern California, which when we look at our charts, that's 2012 numbers. It's amazing. Stuff cash flows with debt in the 6s, no problem. You can find cash flowing deals. You can negotiate. You can get reductions. You can get credits. There's tons and tons of listings available, and yet there's no buyers. So, of course, right? Because people remember what's been their recent experience. If they've been in real estate, they have been having a bad time. A lot of people that own properties like myself, I haven't been able to be a buyer the last 2 years. I've had to preserve my liquidity in order to put money into the buildings and keep them, whether that's, paying down principal in order to refinance, or, replacing major systems, or dealing with vacancy or anything like that. I haven't been able to be a buyer, and I would love to be a buyer right now. I think I may be able to do something by the end of this year, finally, for the first time in a while. So there's a lot of people that normally would be your competitors that are not in the market right now. So from what we're seeing in our brokerage business, a lot of new entrants are taking advantage of that. People are getting amazing deals. Of course, they don't know what an amazing deal it is because they weren't in the business before necessarily, but it is a great time to get in if you can understand that you're investing counter to the sentiment today, but that could be a very different story 6 months from now, and you might be really happy.
It's a really good point, because I remember in 2010, 11, and 12, so I started my meeting in 2011, and all my meetings were nothing but economic. The whole meeting was, people would tease me about my stack of paperwork until I figured out that I could PDF the whole thing and people could look at it later, or look at it on their phone. But I would you would walk in and I'd hand you a stack of 50 to 60 pages. Okay, we're going to go through all this conversation about the Greek crisis, the pig, the shadow market, what's the Fed doing, right? The mark to market or not. I did that for 18 months. And then finally, middle of 2012, I'm like, okay, guys, market's done. It's bottomed out. Go buy. That was my last one. And I just started getting speakers because, I tracked the market. But I was losing money that entire time. And I could not invest. I was selling. I sold every door I had. Yeah. So I was selling and hurting, not buying. And that's part of why I'm so aggressive now in this market, because I've been waiting for 15 years for the multifamily market to be in enough pain that cap rates are seemingly quote unquote sensible, but mostly that I can buy a cash flowing building day one with a high interest rate, which means in 3 to 5 years, I can refinance the building, and it is an automatic value add. If the building can cash flow today, I have a gem. But what I'm seeing in Tulsa, and this is what I want to get to, is I'm seeing highly damaged buildings that are 30% occupied, 70% unoccupied because they have water damage, burst pipes, or they have fire damage, or they've lost the electricity in one of the buildings altogether. And so now there's a deep reno. Yeah. So you buy it for $3 to $5 million, and you have to put in $4 to $5 million to fix it, because the amount of damage of the deferred, right, that has accumulated as they tried to hold the building up during this downturn, right? Like you said, we're 4 years into it. So 3 years ago, the building started failing, and rather than failing the building, selling it, doing what they now couldn't do anything, and now they didn't fix the electrical, or they didn't fix a fire problem, or they didn't fix the roof, and now the whole building has, one of the buildings is wiped out because the roof had a big leak which went through the entire building. They collect the insurance money and they don't fix it. Eventually, after that happens, the bank forecloses on them, and now it's on the market as a foreclosure. So I'm seeing slightly different assets than what you're seeing in LA. But let's talk about the value of the LA market, because I think for somebody like me who's an older investor, and I used, my first building was a 7 cap in Sherman, in the Valley, Van Nuys area on Magnolia, and it was a 7 cap, and it was a cash flowing building, right, which doesn't exist as much in LA, but there is a deep value in LA that people miss. So let's talk a little bit about that.
Yeah, I mean, it's really different here in a lot of ways. We don't have a lot of the buildings that you're describing.
Yeah.
I very rarely see completely or nearly destroyed properties on the market. I very rarely see foreclosures. There's a lot of demand here, but the biggest difference in LA is the supply and demand picture for rental housing here, right? We have a severe supply shortage. Say what you will about, policy here for housing production, it hasn't been effective, right? And who knows when they're going to be able to make it effective, but we don't have enough space to live. So compared to a lot of other markets that are dealing with huge pressures from new supply and issues with vacancy on even slightly older buildings, we don't have that problem here. Our vacancy rate is still around 5%. It was even lower, like in the threes, going back a few years ago. So it has softened a little bit. The new supply here is Class A, super, super nice. It doesn't compete with the properties that, me and a lot of our clients are buying. That's like the B and C type stuff. It's just not a threat to us. So you have that dynamic going on that virtually guarantees that you're going to experience some level of rent growth and appreciation into the future.
When you say aggressive rent growth, what are the numbers you're talking about?
I mean, I think we're going to go back to 1 and 2% for the next few years.
There was a point where it hit up to 16%.
Yeah, it was crazy for a while. Yeah, I mean, you'd buy stuff and every year you'd be getting 10% plus growth on market rents. It was like that. The market needs a while to normalize, and it is, but it's going to be, I don't see that coming back anytime soon. That being said, we haven't solved our supply problem here either. And the demand is still here. Say what you will about the U-Haul charts and people moving out of town, not enough to change that the demand is here, and there's people moving back now too.
And that's what's important to understand. So flesh and blood on that, because California does have a bad rap. I'm going to say for good reasons. Don't hit me through the video, but for good reasons, California has some bad raps.
We deserve it.
It is a state where people reoccurringly come back to.
Yeah.
Right?
Yeah,
So
we see that. Well, we see that more and more. We see that with residents coming back from moving to lower cost of living places. The return to office is a real deal. Remote work is not as common as it was. And then we see that for investors too. A lot of people took their money out of state because the yields in the last cycle were quite a bit higher in a lot of these, southern, southeast, Sunbelt states, red states, whatever you want to say, right? Mm-hmm. Even next door in Nevada and Arizona. And that was super popular, right? But what happens with that is you get the lower regulation in those states as well. That money is being seriously challenged with a lot of this competition from new supply. And now cap rates across the board have risen so much that we're getting a lot of people coming back here and seeing our cap rates are in the sixes too. And you can buy something 7 blocks to the Pacific Ocean and the weather's still nice, believe it or not. It was nice when you left. It's still nice. And yeah, people still really want to live here. So people are looking at that math and the supply side things that we were just talking about and thinking, wow, maybe this overregulation thing actually did us landlords some favors over the long run. Same thing with the rent control. It's not fun to manage around, but and it doesn't work. But it creates an artificial constraint on supply of rental housing. And so what does that do to market rents? It pushes it up. What does it do to supply? It pushes it down. So if you are the incumbent and you own property here, you're going to do really well over a long period of time. It's hard to manage that stuff. But if you learn it, you play within the rules, you're going to do really well over a long period of time. And you don't have to have this going on with the performance of your property. And at a time like this, typically these gateway markets, like the big institutional money understands this stuff and they're buying stuff here aggressively. There are very few times in the cycle when you can pick assets up in these gateway, tier one, primary, whatever you want to call it, markets where cap rates look like this. Most of the time we'd expect cap rates to be 100 to 150, 200 basis points lower even than where they are now. And so you can pick up high quality assets at a really great basis, a serious discount right now. Probably no time since that you've been able to do this in the last 15 years. And there'll be a small window right now that we can do this. And typically this will last and it'll go away and it'll be gone for another 10 to 15 years again.